Friday, May 29th. The U.S. president walked into the White House Situation Room to make his final determination on the Iran deal. He walked out. No announcement, no word, no deal. This chart shows the immediate market reaction. Oil dropped 4% as investors anticipated a signed deal, then immediately spiked back up once it became clear the table was empty. That reversal followed a statement from Iran's parliamentary speaker, delivered from the legislative floor. Quote, "We seize concessions not through dialogue, but with missiles." The world's critical energy supply is currently trading outside of its usual supply and demand fundamentals. Price swings from $144 a barrel down to $95 now correlate directly with updates posted to social media by the negotiators themselves. Neither side has a clear incentive to settle. The United States needs petrol prices down before November's midterm elections to ease domestic economic pressure. But for Iran, a quick deal offers little protection for their decimated leadership, while every week the strait stays closed increases the economic cost for the American administration. Despite this, the S&P 500 is hitting all-time highs. Markets are valuing corporate earnings, as if the global economy isn't currently missing 14 million barrels of oil every single day. Looking at the physical supply, the numbers are different. In just 3 months, cumulative supply losses have reached a massive milestone, 1 billion barrels, completely gone from the global market. Financial markets are pricing in a resolution that hasn't arrived, even as the physical supply that powers the global economy continues to disappear from the map. Most analysts assume that reopening the Strait of Hormuz will immediately cool inflation and return global trade to its pre-war state. However, the mechanics of the oil market suggest a much more volatile outcome. First, consider the UAE. Having recently left OPEC, they are no longer bound by production quotas. They have 4.85 million barrels per day of capacity ready to go. The moment the strait opens, they will flood the market with years of suppressed supply. At the same time, any deal would likely include sanctions relief for Iran. This would allow millions of barrels of Iranian oil to re-enter the market simultaneously, creating a massive, uncoordinated surge in global supply. This creates a direct crisis for Saudi Arabia. The Saudi national budget requires oil to stay above $80 per barrel. A simultaneous flood from the UAE and Iran could push prices well below that level, stripping Saudi Arabia of its market share and fiscal stability. Reopening the strait isn't a simple return to normal. It's the likely starting point for a price war between the Gulf's 3 largest producers. That risk is now being factored into long-term energy contracts. While the primary combatants face these risks, one country has stayed silent. China has avoided taking a public stance, yet its exports jumped nearly 22% during the first 2 months of the conflict. China is using the crisis to secure its energy future. They have been buying suppressed, crisis-priced oil to fill their strategic reserves, absorbing roughly 1.2 billion barrels, nearly half of the total global supply drop. Simultaneously, they are scaling Enbridge. This is China's alternative to the US dollar-led financial system, connecting the UAE, Saudi Arabia, and Thailand. During this war, Enbridge has processed over $55 billion in transactions, a massive increase over its 2022 levels. By accumulating cheap energy and building an independent financial network, China has secured a strategic advantage without firing a single weapon or participating in negotiations. This stalemate translates directly into domestic costs. Because oil has stayed above $100 a barrel, U.S. inflation reached 3.7% in April. This leaves the Federal Reserve no room to cut interest rates, which keeps mortgages and business loans at their highest levels in decades. This supply chain choke point extends beyond energy. 40% of the world's nitrogen fertilizer exports pass through the Strait of Hormuz. With the passage restricted, urea prices have risen 50%, and ammonia is up 20%. Because agricultural cycles are long, these costs take time to manifest. It takes 6 to 9 months for fertilizer prices to impact harvesting and shipping, meaning the full scale of food inflation has not yet arrived at the supermarket. A stalemate in the Gulf has led to a sustained increase in basic necessities, from the interest on a home loan to the price of a gallon of milk. This creates a strange disconnect. The stock market is at record highs, and corporate earnings remain strong, even as the energy and agricultural foundations of the economy are under severe pressure. History shows that markets can be slow to recognize structural damage. In 2008, financial markets remained optimistic for 18 months, while the underlying housing and credit systems were already failing. As of tonight, the deadlock remains. 1 billion barrels vanished, 14 million shut in, interest rates on hold. The question is whether the walkout from the Situation Room was a tactic to gain leverage, or if the conflict has reached a point where neither side can afford to settle. To see how the eventual reopening of the strait will trigger a global price collapse, click the next video on our channel.